Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, sales leaders, and other important players in the industry who will help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and their Dakota Live content, please check out dakota.com to learn more about their services. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker, who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Well, I am very happy to introduce our guest today, Jason Chang, Managing Director and Head of External Equities with Lockheed Martin Investment Management Company. Jason, welcome to the show.
Thank you. Pleased to be here.
It's very nice to see you. And as always, Tim Dolan from Dakota.
Hi, Robert.
Welcome back to the desk.
Thank you.
Good. I was going to ask you about pumpkin spice lattes. I decided not to. I'm going to wait till later in the show.
We'll pass on those. I've never had one.
Just in the interest of time. But it's great to see you, Jason. Thanks for being here. I'm going to very quickly read your biography for our audience, and then we'll get right into the questions. So Jason Chang is the Managing Director of External Equities for Lockheed Martin Investment Management Company. He has also overseen private equity and real estate during his time at Lockheed. Lockheed Martin Investment Management Company is the investment arm of the Aerospace and Defense Company, headquartered in Bethesda, Maryland. Prior to joining Lockheed Martin, Jason was a vice president for the alternative investments and manager selection team at Goldman Sachs, where he focused primarily on long-only manager selection for non-U.S., global, emerging markets, and Brazil. Jason has spent time as an equity research associate at Morgan Stanley, where he covered biotechnology. Jason has an MBA in finance and accounting from New York University Stern School of Business, an MA in medical science from Boston University School of Medicine, and a BS in biomedical engineering from Northwestern University. Finally, Jason calls the greater Bethesda area home with his family, and we are very happy you are here. Congratulations on all your success, Jason.
Thank you so much. Appreciate it.
Well, as I mentioned, we are very happy and we're very interested in your background. It's always interesting to see someone with a medical kind of biotech background kind of come into finance over time. So what inspired you initially to pursue a degree in biotechnology engineering?
Well, coming out of high school, I thought I wanted to be a doctor, and I was good at math, good at science, and thought it'd be a really good foundation for building a career in pursuing healthcare. I think I wasn't sure if I wanted to do biology specifically or biochemistry, and with a mathematical orientation, engineering seemed like the logical path. What I didn't know at the time was biomedical engineering was the second hardest major at Northwestern. So in retrospect, if I could redo it again, I might take an easier path, but I can't really say I regret any of the roads I've taken since then.
What was the first hardest major at Northwestern University?
Chemical engineering. They were paid the most, but they had to go through the most. And I think you had to be pretty much a masochist if you wanted to do pre-med and chemical engineering at the same time.
That's amazing. So at the time when I was trying to figure out how to program my VCR, you were predicting the next big thing in biotech. So it's very impressive from our perspective. But all kidding aside, it's really interesting time in biotech to not only get your degree, but coming out into Morgan Stanley, covering biotech companies. I think it was only a few years before the human genome was released, at least the first draft sequences of the human genome were released. So what was that like for you at that time at Morgan Stanley, covering biotech companies when there was so much change happening within the industry?
It was a challenge. I mean, as you referred to, my background had been in healthcare. It was more on the science side of things. It was quite the transition to go from science to thinking about it from a financial perspective. So, one, kind of putting that together. But secondly, there was a lot of change going on in biotech. I wouldn't call it the wild, wild west, definitely not like that, but there's a lot of change going on at that period of time. And we're right between the cusp of the old approach, which was more focused on complex molecules, to biologics. Today, everything is in biologics. Everything's based off of antibodies, built off of organisms. So as you were trying to transition between what had worked in the past to what was potentially going to work in the future, it was hard to kind of figure out what would the science between what would work and what wouldn't work. So a lot of time spent at the time understanding the pathways, how someone was differentiated, and a little bit of guesswork at the time on ultimately which companies had the right approach.
It sounds a little bit like manager research. So trying to figure out what worked and what doesn't work and what's going to work in the future.
And it's constantly evolving. So even today, I think with some help from technology, there is still a bit of art to the approach and to the work that we do.
Yeah, agreed, especially when you're considering people and the decisions that people make in terms of their investment portfolios. But you did start to really cut your teeth in manager research, as I mentioned before, at Goldman Sachs. It was a great place. Actually, we overlapped for a bit, for a few years at Goldman. And the first half of your nearly 8 years at Goldman came during a very interesting time, the great financial crisis obviously going on. So looking back at what you were responsible for, which was primarily non-U.S. public equities, what criteria were you generally looking for in those managers at that time?
Sure. Well, where I sat in the GEMS team, we were primarily creating products or identifying products for the high net worth, the private wealth management platform. So as a result of that, there were two paths you could follow. We created strategies that fit into 3C7 funds, so private funds where our clients would invest as effectively a shareholder, or they could get their own separately managed accounts through the WRAP program. That posed quite a bit of challenge back in 2007 because you had to invest on the international side through ADRs. If not ADRs, then they were creating P notes, which people weren't that familiar with at the time. So there were a lot of international strategies out there, but a lot of folks wouldn't run WRAP. And that's because it was more limiting universe. With ADRs, they had to be custodied in the US. Clients couldn't have global custody. So everything had to be US based. And that actually pretty much limited a lot of the investment universe. Companies that you think today people would have easier access to, like a Samsung, didn't have an ADR. So that immediately cut out quite a bit of the opportunity set. It imposed quite a bit of a challenge in identifying managers who could generate excess return. You're trying to figure out the differences between how they ran an ordinary share portfolio versus an ADR portfolio. And often you could see big divergences in performance because they just weren't playing with the same set of tools or investment universe that they could do on the ordinary share side.
Well, after 8 years, you had left Goldman to join Lockheed Martin. So we're very interested to learn more about your roles and responsibilities. But maybe for our audience who may not be as familiar with Lockheed Martin's investment management arm, can you tell us about the investment management company's role within the Lockheed Martin ecosystem?
Sure. We're a fully owned subsidiary, but independent from the corporation. So in the past, and you see with a lot of corporate pensions, they may be part of the CFO's office. They are linked to Treasury, et cetera. At Lockheed Martin, over 20 years ago, there was a decision made to completely separate the two so that we could make decisions independently. We are not influenced by what's going on in the organization. I think that's to remain investment pure. It's been to the benefit of our plan participants. And frankly, for our CFO and the folks in senior leadership, they don't want to spend time managing this. They have oversight, and the CFO, the treasurer, and the controller sit on board. But we are left to actually focus on one thing, which is deliver returns for our plan participants. We want to remain pure and not have the corporation intrude upon and think about, how are we investing? Are there considerations we have to think about? Our goal really is to come back and say, where are the best opportunities and how do we invest to generate returns for our plan participants without thinking, next quarter's earnings are coming around the corner. How do we manage, how do we think about investments, and is that going to impact quarterly earnings? That is not our primary goal, nor something that we have to think about or worry about. And I think having a separate investment management company allows that to occur and remain investment pure.
Jason, that's very helpful, and we'll dig deeper into that investment management process and finding and sourcing managers. But for our listeners, maybe just an understanding of more of you and your role and your team, your colleagues, how you are built out from a research standpoint. Obviously, we understand you cover public equity, but who are the other key individuals on your team from a research standpoint?
With the size that we have, we're a fully staffed investment management company. We cover all asset classes. We're organized by effectively verticals, but we do interact with each other and have a lot of conversations with one another. So I oversee the external equity book. We have an internal equity book, global equity book, managed by a portfolio manager and managing director. We have someone who oversees fixed income and credit, another individual who focuses on absolute return strategies. We have a quant-oriented strategy internally they run risk parity as well. We have private equity, of course, and then real estate. And in the past, we've had commodities. So you think through any of the asset classes you'd want to invest in, we have someone there or someone who has expertise. The idea being at least in the pension, we want to seek as many opportunities as possible. And we have done so in the past. On the defined contribution trust, which we also oversee, you don't have some of the illiquids that are in that portfolio, but it's something to think about. Are there opportunities to put something in? So already having that expertise in-house allows us to be at the forefront of thinking, how do we innovate and deliver something more to defined contribution clients? I think ideally, in an ideal world, everyone would love to have a pension. But obviously, we know the industry is not going in that direction anymore. But can we bring elements of how we invest in a pension to the defined contribution side? That is something we're definitely seeking and exploring, because I think that would be additive to our plan participants.
I'm curious on the internal equity portfolio, what style or asset class is it? And would you look at a manager to complement what you're doing, or is that the allocation on behalf of your plan participants, is that internal equity for that style?
Yeah, the internal equity portfolio is another diversifier. So when I think through our portfolio, we've got somewhere between 30 to 35 different strategies that we utilize for our global equity portfolio. Our PM internally runs a global core strategy. It brings in elements of top-down along with technical analysis. That's not something we see, or I see as much out in the marketplace today. So it's a differentiator. It's a lot more nimble. He tends to trade around a little bit more. And so for us, it complements a lot of the other investors we have. We tend to favor managers, or at least I like managers who have a little bit of a value bias. We definitely have growth. They have a quality bias, and they tend to be more longer term investors. So the typical investment horizon is 3 to 5 years. That aligns with our longer term focus on the pension. But I think for investment diversity, you do need some folks who are more nimble, people who are a little bit more reactive, some who are more trading oriented. So as I'm trying to put a portfolio together, the benefit of our internal portfolio manager is he'll switch from growth to value. He'll look at the environment. He'll go from large cap to small cap. He'll look at some of the technical analysis. Whereas a lot of external fundamental managers will say, you know what, that's a short-term noise. And, we're thinking kind of 5 years. Well, that doesn't really help me when on a 1-year basis, you may be underperforming. So this allows us to stay a little bit closer to the benchmark. We try to be somewhat benchmark agnostic when evaluating managers, but on a total portfolio level, we do have a benchmark we're trying to beat. It's the MSCI, ACWI, IMI. And so I have to keep in mind the different types of bets that we're making and taking. The internal portfolio, to answer your question, helps balance and create balance in our portfolio.
So you touch on an interesting concept around managing the top down and then having your managers understand more from the bottom up, fundamental, longer term look, and thinking about institutions like yourselves, some pension plans, DC, DB plans, a lot that we find use an institutional consultant as an outside resource, whether it is to help with the top down or from the bottom up research on your end. Do you all work with any outside sources, any investment consultants to help with either of those?
We don't have a specific investment consultant that we're relying on. A lot of the asset allocation and research is done internally. That's not to say, though, that we won't seek help, seek advice from outside sources when needed. It's more specific at the time. We're trying, again, to deliver returns as best as possible. And we're going to seek all the help that we can to do that. But the management of the portfolio is done primarily internally. We don't rely on an outside consultant, an OCIO, for instance, to help us run it. It's by design. We're in touch with it, and we've staffed our team to a maximal basis to allow us to have maximum flexibility and instant reaction if something were to happen.
Got it. That's very helpful. And again, going more to the top down and maybe put us inside the walls of your investment committee a little bit, thinking about how you're tilting the portfolio. I love the comment of we're more value oriented, but we'll own growth. So give us an insight of that asset allocation, where you all are seeing opportunities over maybe the next few months or even longer term, kind of that shift of capital, and give our insight there.
Tim, you're asking a question I wish I had the answer to right now. It's incredibly difficult. I think internally we have a lot of debate on, are we in a growth environment? Are we in a value environment? And I think this is a particularly difficult period of time because you're seeing signs on both sides. But to be frank, I think our approach right now is to say, let's stay balanced. If you lean too far on one side, especially with the way factors have moved the last couple of years, you can really be offsides pretty easily. So I think staying closer to core allows you the flexibility to switch back if you need to. I think there's also the degree of our managers are constantly adjusting as well. So you don't want to necessarily override or tilt too much on one side because you may be overriding decisions. So where we're seeing things right now, it's probably like the marketplace. Everyone's confused. And I'm not saying we aren't trying to figure it out, but there are so many conflicting signs that it's difficult. I think that's where I rely back on identifying, and our team relies back on identifying managers who can generate alpha. And in this place, we're not trying to make a factor bet. I don't think that's a skill set I particularly have. That is great, but I think I'm good at identifying managers who can find good companies. So when I think through our portfolio today, typical portfolio of our size might have somewhere like 20 to 30% of our risk coming from idiosyncratic risk, stock specific. Our portfolio today sits somewhere between 45 to 50. I think that's a pretty good accomplishment that's been done on purpose the last couple of years because we want our alpha to be driven by idiosyncratic stock selection rather than making factor bets, because I think factor bets are incredibly difficult to manage over time.
How are you integrating those risk management strategies into the portfolio? So thinking about the portfolio holistically, what are the approaches or the tactics that you're taking in order to, maybe use your word confusion, kind of eliminate or alleviate that confusion that can come from the portfolio?
A lot of it, Robert, I think, is a systematic or a regular process of evaluating risk. I'm looking at the portfolio on a daily basis. We have predominantly separate accounts. So the beauty that I have every day is I mark to market, and I know what managers are doing every single day, a day later, but I know what they've traded. I will review the portfolio holdings on a daily basis, but that's on a micro level. On a more systematic level, weekly, I'll look through, what people have traded to get a sense of where things are moving. And then on a monthly basis, the team has a formal review. We'll run our portfolio through our risk model. We use BARA, and we'll identify the different types of factors that exist. And we'll say, are these within the parameters of what we're comfortable with? When I say try to run a core portfolio or a neutral portfolio, that's not to say we won't allow the portfolio to tilt in one direction or another, but it's much more about risk management, not allowing to go too far out of the bounds on things. If we're too heavy on growth, go back 2 years ago, we had done quite well in our portfolio, but we looked at our footprint and we said, all this is driven by growth. We need to kind of balance it out. So we started taking money from our growth managers and reallocating to our value managers. That benefited us last year in the difficult environment. We actually outperformed a little bit last year. And I think it's because of the rebalancing, the active rebalancing that we took, not waiting too long. Don't wait for a quarter or a semi-annual rebalance because it might be too late because things are changing so quickly right now. We'll evaluate on a monthly basis and decide, all right, do we need to reallocate our portfolio? That's done on my individual team. On the public equity team, we'll look at our entire portfolio on a monthly basis. But organizationally, we have an enterprise risk management system that's trying to do the same thing also. That's trying to bring in different asset classes. you get a lot of transparency through equities because people are used to it. But how do you deal with illiquids? How do you deal with private equity and real estate? What kind of bet do you have? The enterprise risk system is trying to help us manage that process. Though I would have to say, a lot of risk models out there aren't great at dealing with private equity, so you have to use it as a proxy, so to speak. We know that there's certain bets in private equity. It's probably more smaller cap. There's a lot of tech and healthcare in there right now. So you have to keep that in mind when thinking about the exposure that you have. But that's how you kind of look at it. It has to be something that's structured, that you do on a regular basis, and that you keep yourself what's the word I'm looking for? But disciplined in your approach. Because if you don't, it's really easy to just allow momentum to take the portfolio in a particular direction. Even if you're doing well, you know that you're taking bets to do so. So you have to keep that in mind when managing a portfolio. I think that's the most difficult thing for people sitting in my seat is you're looking holistically and you're trying to manage the short term with the longer term kind of 3 to 5 year direction of where you want to orient a portfolio.
Very insightful and extremely helpful. And obviously in your seat, right, you just touched on what's important to you all. And folks like myself as a fundraiser, right, our job is to get in front of folks like you, right, and present new ideas that you might not be familiar with. And in a concentrated portfolio of 30 to 35 managers in global equities, give us an insight. What's the best way to get in front of you with an idea that you may or may not know of, or if it's more of a boutique or a newer manager, give some insight, like phone call, email, hey, we're going to be in town, like best practices, if you will, for our audience. Because again, at the end of the day, we think we have something great and we'd love to show it to you from an idea standpoint, but we want to follow your lead and respect your process.
Sure. So Tim, this is a relationship business. So a big part of it is getting to know the people who you're dealing with, what they typically seek and how they're angling for things. So we like more concentrated, higher active share strategies. That's something we consistently tell people. So when I'm looking through a portfolio, I'm not necessarily looking to fill a bucket. We have growth managers and I am looking to replace that, but we don't think of it in a discrete function of I've got my large cap growth bucket and I need to fill it. I've got my small cap value, I need to fill it. We're looking for alpha generators and we can portfolio construct around it through overlays or through just different allocations that we make to managers. Where I find people on your side who are particularly effective at reaching out is one, they take the time and understand what's important. They're not just trying to throw product at allocators, because we hear and get, anywhere between 20 to 40 emails a day around it. Strategy that we like, we tend to track a little bit more, but I think it's more of what is the edge with the strategy? What is it that you're doing differently that from others that are out there? What do you think is more sustainable over time? Because frankly, when I'm looking for a strategy, it can be interesting, but how sustainable is the alpha that's generated? How consistent is it? How, to a degree, predictable is it? Because there are, as much as I say we don't fill a large cap growth bucket, what a manager does do, and I have to understand what they do, does perform a function. And I do want to define, so it's a growth manager that has a quality bias, but they think about valuation. They're kind of GARPy. So I expect that to be a little bit more defensive in our portfolio. It's an edge in how they do research, an edge on how the book is managed, how they think about risk management. So I think all of that is important on the front side. How do you gather our interest? It's to say, hey, this is what we're doing differently. This is what this portfolio manager is doing differently. You should take a look at it. If you don't have that, it's something to think about.
I'd love to build on that because we at Dakota, we raise money for high active share, concentrated, high tracking error managers. And with that, in some instances, come with a fee discussion, right? Obviously, the manager thinks they warrant a higher fee. So I'm going a little off script here. But I'd be curious to understand, right? You said you allocate via separately managed account. So there is a discussion around fees. What are those conversations typically like? And again, dealing with a PM that thinks their strategy is the best thing ever, right? And justifying a higher fee. But then you all have to be obviously good stewards of capital and mindful for your underlying plans holder. So give us an insight around the fee conversation.
Yeah, I mean, you're kind of hitting on my favorite part of the job. Not really. Fee discussions are difficult because, to your point, managers always feel like they deserve it. We've got the opposite side. On our side, we've got an alternative option now. In the past, you didn't have passive, but we can always refer and invest in passive. I think with high active share concentrated strategies, there's an understanding that there's higher risk. So as much as a manager may outperform, I like to often remind them that they can underperform too. And when they do, it can be on a massive point. So two approaches to discussing fees. You can do it the traditional way, which is asset-based. And if you're going with a manager that's relatively small or a little bit newer, you feel like you have a little bit more leverage because when we come in a reasonable size, we can become a pretty meaningful portion of someone's book that actually has value. That's the traditional way of thinking about it. When I arrived in 2014, I had a CIO who was very innovative in how he thought about managing fees. Our approach is more performance-based. That can be difficult for some state plans, for instance, because it's a harder concept to describe to their boards. For our CIO, he had buy-in from our board. So performance fees you think about it as relatively low management fee. You pay on performance, and you're willing to pay above what the standard fee would be. So I think there's an alignment of incentives there. When you don't perform, I'm not paying much, to the point of passive or a little bit above passive, because that's effectively what I could have gotten, and gotten benchmark returns. Or when you do outperform, I'm willing to pay up and above what your standard fees are, up to a cap. And why do we put a cap in? It's to prevent managers from going hog wild in terms of the amount of risk that they take. It has to be balanced. That said, any performance above a balance that we typically see, we'll put into a bank. And that's saved up for future years when they underperform to allow them to get back to a high watermark. So there is a hedge fund mentality in terms of how we approach fees. You're seeing more and more acceptance of that on the long only side. And I think for a lot of long only managers, they appreciate the fact that they can have different types of revenue streams. I think a lot of people still like asset-based fees, but to be able to look at and say, I have asset-based fees, when I outperform, I can earn even more. That creates massive alignment of incentives. And I think for us, we're happy to pay for outperformance because that's why we've selected you, to the degree of it's an easier explanation for our board also, to say, fees are high, but we've gotten outperformance. Now, there are CIOs who will say, if you've consistently found a manager that outperforms that much, why not just go with an asset-based fee? But as we know, for every manager, a great manager out there, for every 5 years, within those 5 years, there's going to be 1 year where you underperform. So I think this creates a smoothing effect, if you will, over time. And I think it's really worked to our benefit, because when you go through more difficult periods that we've seen, like the last 2 years, you're not saying, wow, I'm paying a lot for underperformance. I'm now at this point saying managers are underperformed. They need to make it back, and hopefully they bounce back. For the guys who have underperformed the last 2 years, once they get back to the high watermark, we're willing to pay again. But they've also been paid for the periods of time prior to this when they had outperformed.
Jason, I'm curious, when I think about asset classes like international small cap or emerging markets, regional mandates potentially, it can be more difficult to at least from the size of your plan, some of the things that you had mentioned previously, given the size of the plan, given the illiquidity of some of those asset classes, how are you approaching those less liquid parts of the market as it relates to your portfolio and your strategy?
You size it appropriately. I don't think you want to necessarily ignore the alpha that's there. In some cases, you can use more managers. So if you can't get enough out of one manager, and we know you cited asset classes where capacity does matter. International small cap, typically, people won't invest unless they have more than 200 million. Once they hit that level, all of a sudden, all the allocators come in, and before you know it, they're sitting at $2 billion, and they don't have the same liquidity and ability to trade that they did before. So there's a delicate balance that you're trying to strike there. What I find that works is, asset classes that are inefficient, why not explore different approaches like portable alpha that allows you to look at more managers, capitalize on more alpha, and create and identify where efficiencies exist, and to not play in those areas as much, because it's a losing battle more often than not. I think that allows you to go out and find more interesting strategies. But you have to be very careful also of not suddenly creating a closet index with large assets. you can end up closet indexing. I think that's something we're acutely aware of. So that's why we have concentrated the portfolio a little bit more. Those areas where there's a lot of efficiency, use a little bit more passive, but still not fully give up on active either. That's where you can be more targeted, a rifle shot basically with, look at large cap value, use a manager that's got somewhere between 8 to 15 stocks in a portfolio. You ask most large allocators, they go, wow, that's way too much risk. But if you think you couple that with passive, actually the risk is diversified as a result.
You've mentioned concentrated a few times, 30 to 35, manager relationships is certainly concentrated. But when you're speaking with asset managers themselves, how are you defining concentration as it relates to the number of securities in their portfolio? We hear a variety of different ranges from less than 10 to 50 to 100 constituting concentrated. What does concentrated mean from your perspective?
I think it depends on the asset class and the opportunity set. You look at something like emerging markets, concentrated would probably be somewhere between 50 to 70, just because you have so many diverse regions and underlying countries and exposures. On the U.S. side, for instance, S&P 500 or Russell 1000, you can get pretty concentrated there pretty quickly. So I think the conversation varies. Some people run a portfolio of 150 names. They go, I run a concentrated portfolio at 75. You kind of sit there and go, that's really not that concentrated in comparison. So I think you really have to assess it on a opportunity set. So beyond just the broad, if it's U.S. or non-U.S., you also have to see the mandate. So how someone invests, how they define that, and you kind of narrow it down further. If someone comes in saying, I focus on quality, more likely than not, they're probably not investing in utilities. They're not investing in telecom or real estate. Cut that out. And you go, wait a minute, the universe is suddenly smaller than that. They probably don't invest in energy or materials. It gets even smaller than that. So if they come back and say, I invest in quality, I focus on good businesses, you cut out all that, that's a big portion. And they still say, I'm running a concentrated 40 stock portfolio. You go, is that really that concentrated when you actually cut all that out? Probably not. So I think you have to assess it. Taken another way, Robert, also concentration is not just purely on names. As I just kind of referenced, it is investment style. It's sectors. So you can run a concentrated portfolio in tech. Well, if I only focus on tech, that's concentration. But within that, how do you concentrate even further? I think that's something you have to take into account when you're thinking, what does concentration mean to an allocator?
Just one last question. We're always curious, just from your time perspective, where are you spending your time today in terms of asset classes and within public markets? Are there any particular areas that are taking more attention?
Small cap, frankly, it's rife with opportunity, but it's also underperformed versus large cap right now. So I think there's a lot of potential built up there, a lot of coiled springs, effectively. And frankly, on the non-U.S. side, probably more emerging markets. Everyone's concentrated into U.S. large cap growth. Frankly, that's the bet that's worked for the last 5-6 years. And retail's heavily invested there. So that actually points to more opportunities elsewhere because people aren't focusing on it as much. We're not on the saying we need to go out and replace managers right now, but we're always looking to upgrade where we can or lean into areas that we think people are unloved or people aren't focusing on, because that's generally where opportunities exist. I think as an allocator, you're reacting a little bit at times, but you're also trying to figure out where should I be sending the puck next to use the Wayne Gretzky analogy. And I think we're trying to figure out where that puck is, especially given how efficient markets are today with passive. You wonder at some point, does passive actually have blowback, and it works in the opposite direction? If you have a massive sell-off, passive is largely going to get hit because people are going to sell equity exposure. That means large cap names are going to get hit. And that means tremendous opportunities on the mid and small cap side of things. So, that's where we're focusing on, really, on the outside of the US. And then within US, if we are focusing on something, it's more on the small cap side.
Jason, give our audience a little bit of an understanding. A lot of our listeners are new funds, small funds, diversity, equity, inclusion, minority or women owned. Can you touch on, obviously that's a handful of topics, but just touch on the boutique mindset and how you think about newer, smaller diversity and different ownership styles. How does that fit in your global equity portfolio, just as a specific?
We love boutiques because there's tremendous alignment. Often people are younger, they're hungrier, they're looking to prove themselves. I find that people who are in boutiques often have a chip on their shoulder, and they're out to prove that they can outperform and survive. But they also run into issues because they are smaller. They're more asset dependent upon the clients that they have. There is more organizational risk. I mean, you've seen a tremendous decline in a number of independent boutiques because it's basically modeled toward in favoring size right now, because you have size from a marketing perspective. Think of from a boutique. Often the challenge is, how do I get across an allocator's, how do I get the attention of an allocator? It's, you either have to spend a lot of time on marketing, and that takes time away from investing, or it's word of mouth, and you slowly grow over time, and you just have to live with the fact that, you love to be 500 million, but you're going to have to manage 100 million for a period of time before you really prove yourselves and people find you. There is probably a little bit of a subculture within the allocators. We kind of guard our secrets closely. The ones that are doing really well, we kind of want to keep to ourselves. But it's important to establishing a network and talking to other people. And I think that's where emerging managers can get a benefit, is you target the right people, and you know that they have a network. They'll tell their other friends, they'll tell the other allocators, this is something that's different that you're looking at. To answer your other question, Tim, I think for boutiques, for minority owned organizations, ones that are run by women, there are a number of studies we've seen where female run organizations have better performance. I'm not sure why. I think part of it is they may think differently. They don't fall into groupthink. And in this business, there is a lot of groupthink. Minority owned organizations, similar type of thing. So I think it's incumbent upon us, as much as we like the easy, one-stop shop, you see a lot of different things. You have to look underneath a lot of rocks and spend the time. So we will always take a meeting for anyone who comes to us, because it's for us, it just built out our bench. So no matter how small someone is, we'll take the time. So I'd say the advice to a lot of emerging managers out there is, remain diligent, try to find the allocator who's well connected. And if you can get yourself heard there, that actually will help you in the long term. But it's a challenge. It is not easy in this marketplace today.
That is music to our ears, music to our listeners' ears, right? It's don't overthink it, right? You see a plan and a Lockheed Martin that just a behemoth, if you will, from a size standpoint. Just they're open, right? And you all want unique and interesting investment ideas, big and small, and we love hearing that. So thank you for those words.
Jason, quickly, you've also been responsible for private equity and real estate over the past decade at Lockheed. So can you just briefly talk about the private equity book for Lockheed and areas of opportunity within PE that you may be specifically constructive on today? Yeah,
it's been a couple of years since I last covered that specifically, but I'm involved on the manager approval side of things there. Private equity, as you know, Robert, is a question for a lot of people right now, because it is illiquid and people are trying to get as much as they could before, and suddenly they have too much. I think for us, we are evaluating the exposure that we have. We're still on the lookout for managers, but I think the pacing is something we're looking at a little bit more closely. And you have the challenges of, because it is illiquid, different set of questions. Can you get your exposure out? Can you get can you get your capital return to you? I think that's forcing a lot of people to think about how they want to invest and allocate to China, for instance, because geopolitical risks, with the example of Russia, where, suddenly someone says we're closing off the capital markets, that really freezes up a lot of things for how private equity would exit. So I'd say from our side, we're continuing to look for people who generate returns, have good teams, have a wide reach. But I think there is I don't want to speak too out of turn for my colleagues on the private equity side, but I know they're looking at sizing and pacing right now and saying, where do we want to focus? Because the allocation has gotten bigger than it was a couple of years ago, because equity markets, fixed income has come down. And illiquids have stayed where they are. We'll see where they go about in terms of marking their marks. I think there's a general tendency to delay a little bit because they feel like they can weather through. But if this continues down the path that we're seeing right now, I think there are a lot of books that are going to be hit both on the private equity side as well as the real estate side.
Bringing this conversation and your career full circle, how are you approaching the biotech sector as it relates to your portfolio?
I love biotech. If you ask our managers, they will tell you that it can be risky. I find it reassuring when managers come and say, "This isn't my expertise. I'm not going to focus on it because it is too binary for some people." But we have biotech exposure. Generally speaking, a lot of the strategies that we have that have invested in biotech are companies that have a product out there right now. It's less about those that are in stage 2 or stage 3, and you're highly dependent upon that, especially if it doesn't work. We've seen over the last couple of months, if something doesn't work, a stock will go down 40, 50% in one day, and that's a big hit and big bet to take. So I'd say biotech is a growth area. But you have to find managers who have experience, can identify and understand the pathways that exist for different drugs. Some companies are platform based. They have a pathway they think works, but there are multiple shots they can take on different types of diseases. So that I think it's an area that continues to be exciting for me. It's just like AI or technology, and there's growth potential there. But there's also, as we experienced coming out of 99 and 2000, just mentioning AI in a conference call or mentioning genomics on a conference call is not enough to guarantee that you're going to be successful there. We can throw .com and everything back then, and we know how many things failed. So we're probably seeing a little bit frankly, through AI right now. There's a lot of hype, and I think people beginning to sift through on what does that actually mean to someone, and can they actually execute on it? I think those are the big questions. So as it relates to biotech, do drug platforms actually have the potential to take multiple shots? Because healthcare it's unpredictable. What you think may work perfectly suddenly has a side effect, and that pretty much torpedoes entire drug line that you were trying to get approved.
Yeah, absolutely. With very long time horizons as well. So those are valuable insights. Thank you so much, Jason. Well, we are very grateful that you've been able to spend so much time with us today. We're also grateful to speak to someone who's been in manager research for as long as you have. So just a couple last questions. Just curious, from your experience, you've been in this now for 2 decades. How have you kind of approach some of those times in your career where, it's felt like uncharted territory? It feels like you're mapping something new. And how has that shaped your decision-making process?
I think it helps to go back to the process. So while you may be entering an asset class that you don't know, take Brazil for me back in 2010, knowing how you think about research and applying the same process or basis, that each asset class or region might be a little bit different, but having a consistent approach to how you think about, breaking down returns, understanding the qualitative standpoint, understanding an investment process, testing that. I think you have to take very much a scientific approach to investing and, frankly, decision making. We don't want to be preachers. We don't want to be politicians. We want to be more people who are scientists and take it in a systematic fashion. That actually, I think, helps center you over the longer term. But it's really hard to do that because when you got a lot of things, when things aren't working for you, no matter how hard you try, you can get really frustrated and you feel like you want to just throw in the towel. But if you go back to having that scientific approach to it, I think that'll help you win out over the longer term.
Well, I think you just titled our podcast, "A Scientific Approach to Manager Research." So thank you very much. We appreciate it. Well, we always like to end these podcasts by asking our guests, the people who have shaped their careers, the people who have really shaped them as individuals, as you sit in your seat now, working with a very successful company and with a very successful team. We'd love to hear the individuals, the people who have helped you along.
I've had a lot of mentors, colleagues who've influenced me over time. It's hard to name a specific person because I've taken so much from different people. I've got plenty at Goldman that I can look at who've been in the business even longer than I have. Other allocators I've spoken to. So I'm going to duck on this one, Robert, and not name someone specifically, but can tell you that in this business, it is very much about maintaining those relationships and having people who can come in and talk to you and say, hey, this is how we've dealt with this manager that you've invested in. We look at it as a two-pronged approach. When one's underperforming, we add to the other one and balance it out. It's like, okay, that kind of makes sense. Or, hey, you may want to think about, digging a little bit deeper, going through that in our work. I can't say any one specific person because the approaches are different from so many different people. But I think taking that all into account, I couldn't have asked for a better training ground than Goldman Sachs, because you're exposed to so many different things. But I also say Goldman prepares you only so much until you get to the side where I'm at right now, being an allocator. The experience I had with the CIO who I had when I came in, Chris Lee, also helped me think about managing risk. I mean, it's one thing to go out and find the best managers out there, but you have a P&L to look after at the end of the day. You have plan participants that are dependent upon you not losing capital. So I can love the beauty and idea of finding someone who's really good at stock selection, but I still have to manage my risk. That was the one thing Chris reminded me constantly is you can't lose money. And that's money that people are depending on you for retirement. When you take that into account, suddenly you go, whoa, I really can't take as much risk as I wanted to, because that could be potentially harmful and something I can't recover from in the long term. So little bits and pieces from different people, but I think that's helped become and shape who I am today.
That's excellent. And thank you so much for sharing that. Jason, thank you for taking time to be here today. Congratulations on all your success. We look forward to more accomplishments and following along in your career. So we wish you nothing but the best.
Great. Thank you so much. Appreciate the time.
Well, if you want to learn more about Jason and Lockheed Martin, please check out their website at www.lockheedmartin.com. You can find this episode and past episodes on Spotify, Apple, Google, or your favorite podcast platform. We are also available on YouTube if you prefer to watch while you listen. And finally, if you like what you're seeing and hearing, please be sure to like, follow, and share these episodes. We welcome your feedback. Jason, thank you for being here today. Tim, thanks as always. And to our audience, thank you for investing your time with Dakota.
Don't say goodbye.